Get your calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
And there's the bell, Stu. Can you say rally? Big rally today, huh? About 3%, I think.
Say rally, that's for sure. This is a rally of a rally of a rally. Let's go.
I was a little surprised to see it rally prior to the Fed announcement, seeing that on Tuesday and then another big candle yesterday and one today. Who would have guessed?
This goes to show anything can happen.
And more things can happen than will happen. Correct.
And they will. That's exactly
so I want to
correct.
welcome everybody here to another edition of Coach's Corner. We bring you this every Thursday at 4 p.m. to help our viewers out there, our market rebels and those on YouTube, gain a different perspective from professional coaches and traders and how they make decisions in the markets, because that's really what it's about. The longer you're in this game, you'll find out it's not so much about here's what I think the stock is going to do and let me go place a trade. We have to have reasons for doing it. We have to have a reason for putting these trades on or taking them off. And that's what we're trying to show you here. And as always, we start off with Chalk Talk, a little bit of a trivia question here, which we're going to answer at the end. So Stu, today's question, another good one. What's the most important part of a trading decision? I know there's a lot of different potential answers, but of the answers given, the amount you could lose, is that what you kind of look at, base your decisions on? The amount you can win, or volatility? So I want everybody out there to think about that, jot down an answer, and we're going to come back and visit at the end. Yeah.
Bill, do you go out on the street and take a poll of people passing by what their answers are?
I feel like I do need to go out there with the man on the street and the microphone. And what do you guys think? Yeah, they'd look at you like you have two heads with that question.
Yeah. Okay.
But we're going to talk about that today. And we think this is probably, if you had to pick, Stu, a topic in all of options trading, this would probably be the most important, or at least among the most important. And it's also probably the most misunderstood. And so that's why we want to talk about it today. And that is why watch volatility. Now, we're only going to, it would definitely be on the hunt for sure. We want to just show you try to make it as easy as possible why we want to at least consider volatility, which I'm also including historic and implied in that category. Not so much about the hows and how we go into the details of actually making comparisons, but it's just to make people aware why we get so hung up on what's the volatility, what's the implied volatility.
Bill, you didn't even mention my Eagles, man. What's going on?
My God, I couldn't even see it. You're out of the camera.
There you go. Look, man. See, there you go. Eagles. Go Birds.
Go Birds. So I think that if you were to ask most people, they would say, who cares what the volatility is? I can see that the options price is 3. What else do you need to know? I think the stock's going higher. I can afford to pay 3, or I can afford to possibly lose 3. Let me buy the option. And they say, why are you wasting your time with this whole thing about volatility? That's just the academic stuff. Nobody cares. Well, nothing could be further from the truth. And that's what we want to show you. Without question. And again, it's a little bit hard to show traders why. And that's what we want to show you right now, is just why we consider volatility. So to start off, Stu, now I know being from Philly, where it's actually 9 degrees, I heard.
Going to be in a couple of days, yeah.
A couple of days. Probably where you're from, if somebody says they have an offer you can't refuse, it probably has a different connotation. But I'm going to give you an offer that you can't refuse. Ready?
Tony Soprano, come at me. Here you go.
Here we go. I'm going to let you roll 2 dice.
Yeah.
And if you roll a 12, that's going to make you a winner. You get to bet $1, and I'm going to pay you $10 if you win. Yeah. Now, so this is a 10-to-1 risk-reward ratio. You can only lose $1. right?
Yeah.
This is the way that everybody looks at it. So what do you think? You want to take this?
I don't like it. I feel like it's horrible. I feel like
But
it's
hold on. What are you not understanding here? It's 10 to 1 on your money. You're only risking $1 to make 10. Why are you not, as a professional trader, why are you looking at that and even hesitating?
because I have to know what my chances are of winning the bet are. Doesn't really, if my chances of winning the bet are like next to nothing, I don't care if it's a nickel. Who cares? It doesn't matter how much I bet. What matters is what's the probability of the probability of what I can win.
Correct. We have to figure out where these
has to balance the probability.
Correct. We have to figure out where these numbers are coming from, and that's really the point.
I feel in my gut this is terrible.
You feel that it's good. Well, all right, let's put Stu to the test here. What do you think it should be, or at least roughly, what do you think? Where would you start to take nibbles at it?
Really? Now you're going to make me figure this out? God,
just roughly.
All right, let's see here. So, all right, I got to get a piece of paper and start writing this out. So let's see, one to win 10 on a roll of the dice. So I got 2 die, and each die has 6 of them. So 6, it's a chance of 6 by 6 is 36. I got one. There's 36 spaces. There's one place to win. So I have to get a 12. And I can only get 6 and 6. So it's one place to win, which means if there's a total of 36, there's 35 to lose. That means there's 35 ways to lose and there's one way to win. So therefore, my friend Bill Johnson, you got to make that win number $35.
Wow.
I have to be able to win 30. Oh, I don't know if that's right, but I kind of feel like that's where we're going. Or my $1 has to go way down. in order to meet the probability. And that's
perfectly said.
I'm not the genius like you are, Bill, but that's how I'm approaching this. This is how my trader head looks at this.
And you're 100% correct. These numbers by themselves, somebody walks up and says, hey, I'll give you the opportunity to bet 1 to make 10 or 10 to 1 on your money, means absolutely 0. So Stu actually did a very good job. I did this chart not knowing that Stu was going to nail it so well, but here's what he's looking at. We have die number 1, 6 potential spaces, die number 2, so they can all be matched equally. So there's 36 possible spaces. There's only one way to get a 12, and that's down here. So
0.7%.
Yeah, so remember, there's one way to win, 35 ways to lose, which is what we talked about last week. So if we look at this chart here, put it in a histogram or a bar chart, it would look like this. And look at that right there in the center. Stu, 7 is the most common combination.
7 out. There you go.
See that in craps? There you go. There you go.
Happens.
For the pass bet. But anyway, look over here by itself, 12. And it lines up here at 1. There's only one way to get 12. So what Stu was interested in was not the 10 to 1, 20 to 1, 5, whatever the numbers might be. That means nothing. What he's interested in is either this, and this is just a picture form of that. And so if you have one way to win.
Price by itself tells me nothing.
The price tells you absolutely 0.
The reward by itself tells me 0. Together, they tell me.
I was going to say, and even together, they tell you 0. We need to know where they came from.
Where do they come from? What's the distribution of winning and losing look like?
Which is what we talked about last week. That's where these numbers are coming from. So if we have one way to win, 35 to lose, it's 35 to 1 against you. That's what that means.
Wow, I had it right. Did I do that right?
You actually did have it right. So it means that you should be betting $1 to win 35 or $2 to win 70. You should always get 35 times the amount that you bet. You bet 10, it should be $350. But what was the offer?
10.
1 to win
it's
10. It's
not
enough. And yet, what we're trying to show here is that too many times traders would say, wow, I can bet 1 to make 10. And I think the stock's going higher. I can only lose $1. I can make 10. What a great deal, I'm in. And it is not enough information. You're acting
on. And you might win. You might win on that.
Good point. Yes, you can have unfair odds, and you can certainly win.
You win mega money on that bet, but over 100 or 1,000 or 5,000 or 10,000 trades,
not happening.
years, you are guaranteed to be on the street.
You're going to go down in flames. And in fact, speaking of that, I actually happen to do that. Here's 2,000 simulations of that game. Didn't have time to sit here and do this, Stu, but here's 2,000 in Excel where we are betting 1 to win 10. Now, we could also figure out, I didn't show how to get this, but we have a 69% edge against us with this ratio. So mathematically, we should expect to lose 69% per dollar times 2,000 or 1380. And take a look at where this graph lines up. Almost at exactly 1380.
And
So
you know what
it's-
I'm going to say?
It's
I'm
just
not
showing
exactly
that the
sure
numbers.
it came 69%, but
Mhm.
I'm not going to bet something that has a 69% edge against me.
It's a fat chance of winning.
It's just not part of my universe.
Right.
And if it is going to be part of my universe, it's got to be a dollar amount that meets that probability.
And actually, that's another good point, which we've talked about before. It's not that it's wrong to take this. Stu said it's not part of his universe. It doesn't mean it's wrong, but it's wrong if you're doing it at unfair odds. That's the thing. Somebody might want to take a long shot, which is fine, but make sure that at least it's fair or a potential edge in your favor. You've got no chance of winning this.
You might have or think you have information that might
Think you have.
change distribution for you
That's a
to
whole
make-
different argument.
to balance out in your favor
Oh.
and create an edge for you. Just
And that
because
was-
that distribution exists in the marketplace doesn't mean it has to be your distribution.
Correct. That would be the implied volatility. So going back to the dice, now, of course, the dice are never going to change over time. That will be exactly the same. But hypothetically
They do
speaking,
in
if for
New Jersey.
if for some reason, yeah, we thought maybe they were loaded dice or something that we thought the distribution was going to behave differently, we might take bet 1 to make 10. But this, again, tells us that we need the picture to assess the problem, not the other way around. So as Stu said, price revealed nothing. This is what you want to take from this presentation. And specifically, what else reveals nothing? Reward reveals nothing. Price and reward together reveal nothing. Somebody says, here's a trade where you can make 35 to 1. Don't know. Not the least bit interested. I might
I have
be,
no idea.
but I need to know the picture. And yet most people do not do that. So again, here's the whole idea that we're trying to get through to people. If you know the picture or the distribution, we can figure out that bet 1 to win 35 is what we would call a fairly valued bet. You would expect to just break even in the long run. We can also figure out that bet 1 to win 10 is a bad bet, as Stu figured out. And we can also figure that bet 1 to win 40 would be a great deal.
There you go. And that's where I'd be in. And this dollar that I'm betting, that shows up in everybody's implied volatility on their matrix, on their trade platform. That number shows up. It doesn't show up as well. It does show up at 1, but it shows up as a number of implied volatility.
Correct.
And that's what you got to look at, because the implied volatility has a home. It lives at a level. It has a place that it calls its home address. And a higher volatility could indicate that maybe it's a little bit too high based on the distribution. And a lower probability will indicate that it's a little too low for the distribution. Got to think about all the reasons why, but at least it gives you a space to work in, a range to work in. The dollar itself means 0. The applied volatility number means everything.
Very well said. So the thing to take from this, for all the viewers out there, all the traders, if we have the picture, we can figure out risk and reward. If they're good, bad, indifferent, awful, whatever. But the reverse is not true. If we have the numbers, but we don't have the picture, we can't make an assessment anyway. All I can tell you is I don't know. But yet, this is how most people look at it. They'll say, oh, look at this vertical spread. I can pay 1 to make 4. I'm only risking $1. I can make 4 times on my money. It's a bull spread. I think the stock's going up. What a great deal. It's looking at it completely the wrong way.
How about if we did something like this, Bill? How about if we said, like, well, we're going to do 1 contract, it's $100. $100 is $100. How about if we did 100 contracts? How about if we did 1,000 contracts? All of a sudden, that number is like going to the moon, but the probability of the trade and nothing about the trade really changed. It's just the dollar amount changed. At some point, we just stop doing it. It's all a relative number. And if it's a bad trade on a probability basis, it's a bad trade, no matter what the number is.
Which is why it's a very good point where some people say, oh, it's only $1 or I'm only risking $1. It's the ratio that you want to look at. And that's why sometimes traders say, why would you're talking about this 30-cent edge. I'm not interested in 30 cents. Well, if it's to pay $1 to make 30 cents, it's really 30% on your money.
And if you
we can scale it up to anything we want. We can make it $1 million trade, but we still need to know the probability before we make that decision.
And if you really want to put that $100 up, and you know that these odds are way against you, I mean, I would never tell you not to do it, but just understand that you're way into the area of I'm being a gambler. And if that's what you want to do for entertainment, then go for it. It's okay. There's nothing wrong with it. As long as you know.
Don't be surprised when you lose.
Yeah. People go to the roulette wheel all the time with $100 in their pocket and they put it on the table and they play for a half an hour or an hour and say, hey, I lost my $100, but I had a good time. Well, that's okay.
Right.
That's okay. But you don't go there expecting to win.
Right. It's a different story. It's a different story in the stock market because most people, even though there can be an entertainment value to it, they are presumably trying to make money. And this is why it's so important to understand the pictures. All right. So now, little plugs too for anybody who finds this stuff interesting and wants to take their trading to the next level. Please visit marketrebellion.com/get started. All kinds of free information. And if you even want to sign up with coaching from Stu or from one of our other world-class coaches, you can do so and get all the information right there.
Wait, I got to write that down because I got to do that.
You got to remember that. Now we're going to change it up a bit. The first example that we just did here assumes a distribution that never changes. Right? You look at statistics books from 50 or 100 years ago, it has that exact picture. It will never change. Right. When it comes to options, that is right. For the stock market, that is not usually true. It's perceptions of the distribution. So let's take it to the next level. Let's make it a little bit more like the stock market.
Yeah.
And in honor of our upcoming Super Bowl bet, I'm going to say, I'm going to make you another offer you can't refuse here, Stu.
Go ahead.
I'm going to bet $400 to your 100 and that the spread is 30 points or more, regardless of who wins. There's just a 30-point spread or more. And if that happens, you're going to be a winner. But whoa. Hold. My gosh, you jumped so fast. Hold on a second. It's 4-1. You're only risking $1 to you're making 4 times your money. What are you not seeing here? I'm trying to show you the way that most retail traders look at it.
I can put up 100 and if I win, you're going to pay me 400.
That's right.
Is that what you're saying?
That's exactly what I'm saying. Why would you not take that? That's such a fabulous deal. Great risk reward ratio.
This is kind of like just price. This is going on the matrix and saying, no, I don't want to bet that one. Let me go a little further out of the money. Let me get that one. Let me bet that. $2, I can bet that. Let me bet that one.
Right.
It's a terrible bet. Way thumbs down on this one.
All right. Why do you say that?
Because I'm 63 years old and I've been watching Super Bowls for 50 some years. And I can't remember when there was a 30-point or more Super Bowl spread. The chances of it happening.
Betting against the Eagles, it sounds like.
Yeah. I mean, I don't know what the number is. I have no idea what the number is, but 30 points on a Super Bowl. Come on, man. That's way
intuitively, it sounds like it's not. What would we need to look at here to make a better assessment?
History of the last, 50, however many Super Bowls or
6.
A big piece of that to get some data to say how much was each spread, how much was each bowl's spread to come up with how many of them, what is the percentage of them that actually where the points, where the game equaled the 30 points or more.
Very good. And because I knew we'd be needing this, or at least I thought you'd go down that path, I actually did that. Here are the last 56 Super Bowls and the distributions. Now, these are the actual point spread. So 1 to just a little over 10, 46.4% of the time, 10 to about 28.6% of the time, and so on. Now, it's a very different looking picture from the dice, but it's exactly the same idea. The difference is here with the dice, we could go up and absolutely calculate to the penny, to the nth degree what the answer is. Here, it's not quite so easy because these shapes could change over time. But right now, this is the information we have to work with. And so what, putting you to the challenge again, what would you say would be a reasonably good bet here?
Well, the first thing I'm going to say is I don't really care about the first three steps because
you're not winning there, right?
They're not the 30-point spread. So I'm going to look at the last two, which are the 30-point spread, almost 29. I'm going to call that 30. Okay. And I'm going to put that probability together and I'm going to say, well, 9% or so.
Close enough.
So it's 9 out of 100. It's what's that? 9-10%. It's that's I got a 10% chance of winning. And I'm only getting paid $4 on a dollar. I think, did we already talk about this? It's the same story. It stinks.
It's exactly the same story.
More money. I got to bet less. It's one or the other.
Yep. Always the same thing. Risk and reward are reflections of the same idea of the probability. So I did 91 to 9. I rounded it up to 9% for you, and therefore 91% against you. So think about it. If we had dumped 100 tennis balls into a hat, 9 are green where you win and 91 are red. Yeah. It's 91 to 9 against you. And therefore it should be roughly 91 divided by 9 or roughly 10 to 1.
Time out. You're telling me that I have a 90% chance of losing?
91% chance closer. Yep.
Where do I sign up to bet that? I want to place a bet where I have a 90% chance of losing. Where do I do that? Can I do that?
Yeah, absolutely.
That's what you're looking at. Without looking at a level of pricing and just looking at a dollar of pricing, that's what you're saying to yourself. That's what you could be.
Right. But here's the thing. If it's 10 to 1, it's just a fair deal. But what if it were 15 to 1? Yeah, we might take it.
Now
Even though it appears that we've got 91% chance against us, it's got nothing to do with the decision. It's what are the risk and reward relative to the probabilities. That's what we're trying to show you.
You've got to know the picture. You've got
to know the picture. All right. So again, what's the mantra here, Stu? Price revealed nothing. What about reward? Nothing. What about risk and reward combined?
Not really. No.
Nothing. So if I walk up to you and say, I've got a vertical spread where you can pay 2 and make 8, what are you going to say? Don't know.
What's for lunch? I don't know. I have no idea if that's any good.
We have no idea.
That's 40 years. I have no idea.
Right. Most people out there watching would say, oh, I would easily take that. And what we're trying to show you, it's really the wrong way to approach the markets. This is why professional traders say, yeah, we're going to look at price and reward, but we need to first know the picture or the distribution where it came from first. And if you're not doing that,
let me say, it doesn't make it bad. Maybe your personal idea, maybe you have something that's giving you an edge or giving you a reason to redistribute
the picture.
We could redistribute the distribution or redistribute that picture.
Which really would be the implied volatility in the options market. People are saying, no, we think it's going to be a different picture.
Buy low and sell high. That's it. That's all it is.
So now let's drive it home, show people why this is important for the options market. And as always, before anybody who wants to learn more about this stuff, marketrebellion.com/get started. All kinds of free information to help you get started with options trading. So Stu, here we are in a pricing model. Now a pricing model is a theoretical pricing model. And to make it a little easier, I'm going to do a 1-year option, 360 days to expiration. We're going to look at an at-the-money option. Stock's at 100, strikes 100. I'm going to give it 20% volatility. And it's telling me that the call, telling me that the call is about 791. Now, what this means is that if you were to buy this option for 791 or sell it thousands of times over, no commissions, you would just break even. It's what's called the fair value. Now,
why would I do that?
Now, the question is, how does the Black-Scholes model come up with this? Do they just pull this number out of thin air? Do they just say, it just kind of looks like it's reasonable? I can bet almost 8 to win an unlimited amount. That sounds right. That's how most traders approach it. But here's how they do it. They look at a picture. Here's our bell curve. Now, the reason I did 1-year options is that 20% volatility means we take a $100 stock, we add 20% to it, or 120. That's one
Just
standard
easy.
deviation up. 2 standard deviations would be 2 times 20 or $40, 140, and 3 would be 160.
And these are just stock prices. These are just stock
These are
prices
stock prices.
along the axis, right, Bill?
This is the bell curve over a year. It's our picture. It's exactly what we looked at with the dice or with the football games. But
Where you
now
think the
under a
stock-
bell curve,
Yeah.
for a bell curve, we can't make anything we're assuming this is a call option. We can't make anything if it falls. So that's just a big zero out there. We're not worried about it. To the right, we have a 34% chance in blue. We've got a 13.5 in gray and about 2.3 in red. So here's a very rough approximation of how Black-Scholes work. Halfway between 100 and 120 is 110. So if the stock is 110, the $100 call is worth $10. So $10 times 34%, it's roughly about $3.40 in this area.
Now let me jump in here for 1 second. So how do we know it's $10? If you don't know the answer,
Right.
if somebody out there doesn't know the answer to how do we know it's $10, I strongly urge you to call 1-800, get a coach at Market Rebellion and learn it, because you need to know that. You absolutely need to.
Yeah, that would just be the intrinsic value at expiration. Now,
Yes.
between 120 and 140, halfway would be 130, which would be 30 points of intrinsic value for the 100 call, times 13.5%, worth about 405. And then down here, same rationale, worth about $50 of intrinsic value, but a very small probability. Now, look what happens if we add up all of these things together, which is exactly what we did with the dice in the football game. Same concept.
To come up with a fair
We come
value.
up with 860, and
Well, that's
Black-Scholes
not
came up with 791. But remember, this is a very rough approximation. We're only 69 cents off. It's not bad, considering how crude this approximation is. Now, what
We
Black-Scholes did,
sliced up these deviations.
exactly right. You can see that this blue curve is very tall here on the left-hand side and about half the size over here on the right. It's certainly not those even symmetrical bars that we saw with the dice. So what we can do is we can slice them up in half. We can look at half standard deviations. So
Or quarters.
or quarters, or eighths, or sixteenths. But watch how accurate we get just with one division. Between 100 and 110, that's a half a standard deviation. 105 would be the midpoint, 5 points of intrinsic value, times 19% is about 48 cents. And we're going to do that at every single step of the way.
And now I'm going to add them up, I think.
We're going to add them up, and we're going to get 787, and Black-Scholes model said 791. Pretty
And there
darn
you go,
close.
right? And in real life, these iterations are infinite. So
Super. We would divide them up and divide them. We'd be going into 64s, 120, and even smaller. They would be so small you couldn't even see them. But you can see we're only 3 cents off now, or 4 cents, 87 and 91. Only 4 cents off, and that's just from one division.
yeah, and we can get closer if we want to, but we're not going to do it.
We're not going to do it. What we're trying to show you is that this is where the game is played. What we need to know is this. We
Here's
need
the
the picture. Are we dealing with this? Are we dealing with this? Or are we dealing with this? And the shape dictates price and reward, not the other way around. And yet that's how everybody looks at it.
Let me say that another way. The trade comes first, not the money. The trade comes first, and then the P&L comes.
Yes.
It doesn't go the other way around. It goes, the trade comes first. You manage the trade, you accept the trade, you take the trade, you execute the trade, you get out of the trade at some point, and then the money is there, whether it's plus or minus, that's another story. Then the money is there. The money is not there first. Oh, let me see how I can figure out how to do it. It's not that way.
And that's how everybody looks at it. This is first.
First.
Yeah,
And
you have to
unfortunately, that's how people do it. Oh, $6 to make, 5, or $2 to make 1. Hey, to make 6, or $1 to make 4. Hey, that's a good bet. Let me take that bet. Maybe not. Maybe not.
You don't know unless you know. This is the secret to it. So now let's drive it all home here, Stu. Here's a shot from a few days ago from Microsoft. Here's the mark, the halfway point between the bid and the ask. And here's the way that most traders approach the markets. I think Microsoft is going higher. 11's too high. I don't want to risk 6. 315, that looks like a pretty good deal. I'm only risking 315 and I can make an unlimited amount. That's a good deal. What does this column right here tell you, Stu?
Nothing.
It tells you absolutely zero.
It's just a price. It's just a
It's just a
dollar.
price. When price reveals nothing. Stu and I are not looking at this. We're looking over here. And we're saying, okay, the crowd has priced. Now they've just worked the pricing model backwards. They're saying based on these prices, here are the volatilities. These are the pictures.
Crowd being everyone who's doing this. Retail,
bidding on everybody.
Specialist market makers, anybody who's even thinking about looking at this is creating this market. This is a bid-ask market.
Yep. So now we see that it's about 27, 28%, roughly speaking. We're not going to get into the nitty-gritty about how to go through this, but just say roughly 27, 28. Now we have something we can sink our teeth into, because now I can go and say, here's the historic in blue, and here's the implied in orange. Look at Microsoft, low of 22, high of 55, implied
So
25 to 30. Implied was roughly around 27, 28. So
and let me see that graphic. So you were coming in
we're kind of right here in the center.
Yeah. So it was okay.
It's without getting into the details, it's roughly a fairly valued bet. I mean, you can see Microsoft delivers much, much higher volatilities at times. But would I be gung-ho to sell this one? Yeah, not necessarily. It'd be okay. I wouldn't really be opposed to buying it. It's more along fair value. But the point is that this is how
you could create a strategy to lower your break even and therefore give you a little bit better probability of actually coming out on the plus side of things at the end.
Now we're getting into what trading is about. But do you see how even that statement right there that he made is not about, I can pay 1 to make 4.
No,
so for everybody out there who is approaching trading, looking at the price and also thinking that that's the risk. I'm only risking 1 to make 5 or something. That is absolutely 100% you're barking up the wrong tree.
Big mistake.
You will not have long run success. So with that,
and again, you might have short run success. You might hit it big.
You can always have short run success with the odds against you.
But I'm going to tell you, you're going to fall into the camp of I did really well in 2021, but if the market is choppy or going the wrong way, I'm getting my what.
Yep. So again, what we're worried about is what's the historic or the implied volatility, not what the price is. We're worried about the price once we know the picture. We work at that direction, but not once we have the price to say I can make the trade. So now with that, and by the way, here's how you can do it in Thinkorswim. It's a little more difficult to do in TOS, but you can definitely do that, make comparisons. But now, Chalk Talk. So what do y'all think now? What's the most important part of a trading decision? Hopefully you now know it is volatility. Risk is what determines the amount you can win and the amount you can lose. But that is a reflection of volatility. You have to know the volatility first before you can assess if a trade is worth taking.
What did we say last week or the week before? Risk is the probability of the loss.
Probability of the loss. It's not. You're not a reward manager. We have to know, and the volatility is about the risk.
Right. So pricing gives you it gives you the levels.
Gives you the volatility levels, and we have to say, are these volatility levels acceptable? Yeah. Just like Stu did with the Super Bowl. Okay, yeah, we know the bet, big deal. How often does this happen? Now we can figure out if it's a good bet.
Or how one of our prior guests, Steve Levick, was talking about the Dell trade, and why did that Dell trade get priced a certain way? Why did it get priced higher than the market was at the time?
Way higher, yeah.
Because the probability of loss had to balance the price that they were getting. And the way that we saw that as traders is to look at the implied volatility.
Yeah, the perception was off the charts. Yep.
Yeah, it was off the charts.
So the thing to gain from this, for all of you who might be struggling in these markets, and we know there's a lot of you out there, one of my favorite quotes, remember that in a bear market, money returns to its rightful owner. Yes, you can look like a super genius when the fish are biting. right? And the pond is just chock full of fish. Everybody
Throw a
looks like a
dart, as they
superhero.
say. Throw a dart and you'll win.
Throw a dart, and everybody looks like a superhero. In every
Yeah.
strategy, oh, I was buying out of the money options by 6.8%. I've got all these details and I was always a winner. It must be my magic formula. Nope, it's just because you were in a red hot bull market. But what's going to take it away from you is when things get choppy. And the way that you need to make decisions is to understand to start with the picture first and then figure out if the price and the reward make sense. But it does not work in the reverse order. So good stuff, Stu.
Okay. All right. Figure out what
Or
your picture
undersell.
or undersell and gauge those numbers by an implied volatility number, which is actually, you don't even have to do the work. All you got to do is look at the screen and it'll
The screen
tell
will show
what
you.
the implied volatility is
Absolutely.
relative to where its home likes to be.
And it's mean reverting. Those are all things we'll talk about in the future. But remember for today, we just wanted to drive home a single point. Why is it that professional traders talk about implied volatility? Why do we look at the picture? Because it's really the entire basis for forming a trade. It is not about the amount you can lose, the amount you can win, anything else. You have to start with the picture. So again, if that sounds a little foreign to you, please check out marketrebellion.com/get started. Nice job today, Stu. I kind of tried to push you into a corner, couldn't do it, but any closing comments?
You will one of those days. A shout out to our prior guest, Levick, again, thanks for coming on.
Oh, yes. Big thank you.
Again, he had the right idea when he was asked that question. Know your risk. Know your risk. Evaluate what can happen down the road on something that you may not think is going to happen.
In case your assessment of the picture is wrong.
Just know what you're up against, man. That's it. Just know what you're up against. Don't wait to open the screen and open your computer and look at the screen. Oh my God, I'm down, blah, blah, blah. And then you feel like terrible. Don't wait for that.
Not a good approach.
That's not a good plan. Plan ahead of time to say, well, if this happens, what does my picture look like? And if you're falling off the chair when you're looking at that picture, then you have too much on. You have
way too much on. Yep. So all good topics, things we'll talk about in the future. But hopefully for right now, I know it's a little bit of a mysterious topic for most of our new traders out there, and they keep going, why do these guys keep hammering about volatility? And hopefully you know why. So that's our Coach's Corner for today. I hope it helped, and we'll look for you next Thursday, same time, 4 p.m. And hopefully, Stu, we can break the 500-day moving average on the SPY. We'll have to come back and talk about that next week.
Let's do it. I'll be there.
Let's do it. So thanks so much for everybody for joining us today. I hope you learned something. We'll see you next week.
Take care.